Hello everybody, today we're going to be talking about capital budgeting and capital budgeting decisions. Capital budgeting decisions defined. Capital budgeting is the process of making long-term planning decisions for a business for their investments. There are typically two types of investment decisions. Selection decisions in terms of obtaining new facilities or expanding existing facilities. Examples of that include investments in long-term assets such as property, plant, and equipment, or resource commitments in the form of new product development, market research, refunding of long-term debt, or introduction of a computer. Second is replacement decision in terms of replacing existing facilities with new facilities, and examples of that include replacing a manual bookkeeping system with a computerized system, or replacing inefficient hand tools with computerized equipment. The steps to capital budgeting include, well, there are multiple steps when preparing a capital budget. You first identify potential capital expenditure projects. You gather the information, including costs and the benefits of alternative projects. Evaluate the projects based on financial and non-financial considerations. Select the projects for implementation. Choose the projects that have the expected benefits in excess of costs. Obtain project financing, considering both internal and external sources. You implement the projects, and you control the projects by monitoring the budgets and the performance. Now we go to capital budget evaluation methods, how we evaluate capital budget. There are several methods of evaluating potential investment projects, and they include the payback period, accounting rate of return, also known as simple rate of return, net present value, internal rate of return, which is also known as time-adjusted rate of return, profitability index, also known as excess present value index, and the net present value and internal rate of return methods are called discounted cash flow methods since they both recognize the time value of money and thus discount future cash flows. So now we're going to go and I'm going to show you some examples of each. The payback method. The payback method is used to figure the time it takes to recoup the money invested in the capital project. It is often used to assess such things as financial risk, impact of an investment on liquidity, obsolescence risk, impact of investment on performance measures. Example of the payback method. If the cash flows of a project are equal amount each period, the payback period is computed as follows. Payback period equals the original investment divided by the annual cash flow. So if the cash flows are unequal, the payback period is computed by adding the annual cash flows until such time as the original investment is recovered. If a fraction of a year is needed, it is assumed that cash flow occurs evenly within each year. Here's an example. Suppose that a new car wash facility requires an investment of $100,000 and either has A, even cash flows of $50,000 per year, or B, the following expected cash flows: $30,000, $40,000, $50,000, $60,000, and $70,000. So it asks you to calculate the payback period for each case. So for A, the payback period of for the even cash flows is 2 years. And it shows how we arrived at that. At the beginning of year 3, $30,000 is needed to recover the investment. Since a net cash flow of $50,000 is expected, only 0.6 years, $30,000 divided by $50,000, is needed to recover the remaining $30,000, assuming a uniform cash inflow throughout the year. Accounting rate of return. Before I talk about that, it's one way we use the payback period is to set a maximum payback period for all projects and to reject any project that exceeds this level. And some analysts suggest that the payback period can be used as a rough measure of risk, with the notion that the longer it takes for a project to pay for itself, the riskier it is. And firms with riskier cash flows in general could require a shorter payback period than normal. Firms with liquidity problems could be more interested in projects with quicker paybacks. And another critical concern is obsolescence. For firms with a higher risk of obsolescence, such as computer or MP3 player manufacturers, could be interested in recovering funds rapidly. The payback period can be used to choose among competing alternatives, and the investment with the shortest payback period is preferred over investments with longer payback periods, which is pretty common sense. And this measure suffers from two major deficiencies. It ignores the cash flow performance of the investments beyond the payback period, and it of course ignores the time value of money. So now on to accounting rate of return. The accounting rate of return measures the return on a project in terms of income as opposed to using a project's cash flow. The accounting rate of return is computed by the following formula. Accounting rate of return equals average income divided by initial investments. So an investment requires an initial outlay of $100,000 and has a 5-year life with no salvage value. The yearly cash flows are $50,000, $50,000, $60,000, $50,000, and $70,000. Calculate the net income for each of the 5 years, and then calculate the accounting rate of return. And here's how we do that. I'm not going to talk all the way through that. I'm just going to leave it up there for a moment so you can take that all in. If you can see it, the accounting rate of return at the end is 0.36. You figure each of the net incomes for all of those years. The total net income for the 5 years is $180,000. The average net income, of course, you do the net income divided by the 5 years, $36,000. Accounting rate of return is $36,000 divided by $100,000, 0.36. Now the limitations to the accounting rate of return is, unlike the payback period, the accounting rate of return does consider a project's profitability. An accounting rate of return has other potential drawbacks, however, including the following. It also includes the time value of money, and the accounting rate of return and payback model are referred to as non-discounting models because they ignore the time value of money. And it also has limitations. It depends on net income, and which is the financial measure most likely to be manipulated by managers. So this number can be easily manipulated by managers. And managers' incentive, because bonuses to managers are often based on accounting income or return on assets, managers may have a personal interest in selecting investments that provide the highest net income in the short term rather than the ones that produce the greatest cash flow and returns in the long term. Something to think about. Now on to net present value. Net present value is the difference between the present value of the cash inflows and outflows associated with a project. It measures the profitability of an investment. And the formula for net present value is this. And here is all of how you get to this. You need to have all of this information: the present value of the project's cost, the cash inflow to be received in that period, the required rate of return, the time period, the present value of the project's future cash inflows, and the discount factor. So let's do an example of net present value. Detailed market study revealed expected annual revenues of $300,000 for new earphones. Equipment to produce the earphones will cost $320,000. After 5 years, the equipment can be sold for $40,000. In addition to equipment, working capital is expected to increase by $40,000 because of increases in inventories and receivables. The firm expects to recover the investment in working capital at the end of the project's life. Annual cash operating expenses are estimated at $180,000. The required rate of return is 12%. Estimate the annual cash flows and calculate the net present value. Step 1. That was step 1. I went too fast. Step 2 of the net present value. Well, hopefully you'll go back and look at that. Sorry about that. Here's step 2. Step 1 showed the total, the equipment total, the working capital, a total of negative $360, which you see at the top. The revenues of $300,000, operating expenses of negative $180, which gives the total of $120. Revenues of $300,000, operating expenses of negative $180 again. Salvage value gave a $40, recovery of working capital of $40, and the total of $200,000. That was all of the first step 1, cash flow identification. Then it goes to net present value analysis. The net present value is $117,968. And you use the numbers from step 1. And if you see here, these are all the numbers. On to internal rate of return. Internal rate of return is defined as the interest rate that sets the present value of a project's cash inflows equal to the present value of the project's cost. The following equation can be used to determine a project's internal rate of return. The right side of this equation is the present value of future cash flows, and the left side is the investment. Once the internal rate of return for a project is computed, it is compared with the firm's required rate of return. So if the internal rate of return is greater than the required rate of return, the project is deemed acceptable. If the internal rate of return is less than the required rate of return, the project is rejected. If the internal rate of return is equal to the required rate of return, the firm is indifferent between accepting or rejecting the investment proposal, and it's really up to management to decide. And internal rate of return is the most widely used of the capital investment techniques. It's really the one that I use when making capital budgeting decisions. If the investment produces a series of uniform cash flows, a single discount factor from the present value table can be used to compute the present value of the annuity. If the cash flows are not uniform, then the internal rate of return equation must be used. For a multiple period setting, this equation can be solved by trial and error by using a business calculator or a spreadsheet program. I have used my business calculator that I had in college. I have the same one, and I have used that since college. So if you do not have a business calculator, you should invest in one. I graduated from Southwestern with my bachelor's in 1998, and it is, I guess I've replaced it once. So, but I used it, I'm using the same one that I used in my master's program, which I graduated from Southwestern in 2012 with my master's, so I am using the same one for that. But it's the same brand I used when I graduated in 1998. So, and here's an example. Assume that a hospital has the opportunity to invest $205,570.50 in a new ultrasound system that will produce net cash inflows of $50,000 at the end of each of the next 6 years. Strange example. Calculate the internal rate of return for the ultrasound system. So here is that example. Since the life of the investment is 6 years, find the 6th row in which I have on the next slide, and then move across this row until you find DF is found, which equals 4.1141. And that is the interest rate corresponding, and it is 12%, which is the internal rate of return. So here it is. I've highlighted it. 12%. 6. There it is, right there. Finally, after you are all done and you have selected your capital projects and they are underway, then comes the post-audit of capital projects. You have to follow up, or you have to have external auditing of your capital projects. You have to follow up and have analysis once they are implemented. This compares the actual benefits with the estimated benefits, and it compares what you actually thought your cost savings would be with the reality of the cost savings. So it's very important to have post-audit of capital projects. It evaluates the overall outcome of the investment. And last but not least, it provides accountability to everyone involved in the project. That is my presentation for this week. Again, as always, if you have any questions or comments, do not hesitate to contact me via email, via phone, text, anything you'd like. And I look forward to hearing from you. You guys have a great rest of your week.